how much money should you have saved by the age of 65? So for many years, Social Security considered 65 to be the full age of retirement. And today, 65 is still the age at which you remain eligible for Medicare. As a result, 65 is one of the most common years people begin their retirement. So today I wanted to look at kind of what the average 65-year-old already has in terms of net worth, a couple rules of thumb in terms of how much money you should potentially have, and then one of my favorites is figuring out a safe withdrawal rate to back into just how much money you should have. First, I do think it's worth pointing out that this is going to be a highly individual answer. It's going to depend on your goals, your lifestyle, your income, your expenses, your perceived longevity, all that kind of stuff. But I still think it's a great jumping off point to kind of figure out if you're on the right track and whether you can retire or if you maybe need to make some adjustments. My name is Scott Caulfield. I'm a CPA and a CFA charter holder, and I am the founder of Sophos Wealth Management. So let's start by looking at kind of what's average, or what do other people in their 60s have. So the following data comes from the Federal Reserve Board's Survey of Consumer Finances. So what you can see here, so the mean, or something that's often called the average net worth, is much higher for those in their 60s than the median. This is because those ultra high net worth people, those billionaires, really help drag the average up. So for those in their 60s, average net worth is around 1.2 million. Median net worth, which is probably a better comparison of what the typical person has, more around 230 to 270 for those in their 60s. If you want to be in the 90th percentile, so getting up into the higher wealth areas, medians are closer to 2 million net worths, and the tippy top 1% wealthiest of the wealthiest, you're looking at 14 to 16 million. I think this is just kind of interesting. It really doesn't inform how much you should have, but sometimes, we're human. We love to compare ourselves. Now I want to look at a couple rules of thumb for retirement savings. I like this table that T. Rowe Price has put out. They are estimating how much you should have saved based on your age, whether you're married, single earner, dual earner. And what you'll find is based on what your household income is, they put a multiple on how much savings you should have relative to your income. Now, the multiple is much lower for lower income households than it is for higher income households. In large part, this is because Social Security is going to provide a more meaningful portion of spending in retirement for those with less income. So if your household was to make $50,000 or $75,000, Social Security is going to cover a lot of your needs. If you're a household that makes $250,000, $300,000, you're going to need to have saved a lot more to successfully cover your expenses in retirement. So what you'll see in this table is for somebody at 65, you're going to need to have somewhere between 8.5 to 13.5 times your salary. Kind of a big range, but hopefully that kind of gives you a jumping off point. Fidelity has also come out with their estimates of what somebody should have saved for retirement, and they put a 10x number on your salary for somebody at age 67. Now, if you're going to be a little bit younger, that's going to be a little bit higher multiple, but not much higher. And Fidelity's assumptions are that somebody would replace 45% of their pre-retirement income with asset withdrawals. So that 10x number allows for a safe withdrawal rate. And I mean, if you kind of impute it, that would be like a 4.5% withdrawal rate. So, if we just kind of take a hypothetical example, let's pretend somebody made $100,000 household income. If this was a single individual, T. Rowe Price's table says that they should have 10.5 times their salary saved. So that'd be 1.05 million. According to Fidelity, let's just assume that it's 10x and not slightly higher. Fidelity would put a 10x, so about $1 million. It's a decent, kind of jumping off point. But again, it doesn't give any individual circumstance. It doesn't take into account how much pension income someone has, what their Social Security is going to be. Is there Are their expenses going to go up or down in retirement? How much were they saving of that salary? So you can see it's a good starting point, but it does not give you all the information you need. So let's get into kind of one of my favorite ways of doing it. I do like the 4% rule. It was created by a financial advisor named Bill Bengen. I've done another video on the 4% rule and whether it's still relevant today and what kind of safe withdrawal rates are. My conclusion is 4% is probably a good withdrawal rate in this environment for a new retiree. So with the 4% rule, it assumes that you'll withdraw 4% of your assets your first year in retirement, and then you will adjust that for inflation every year going forward. And historically, that has always lasted at least 30 years, assuming that you've got a reasonable portfolio allocation and you rebalance and all that good stuff. So, if we want to use that 4% rule, what we would do is first, we need to calculate your spending needs in retirement. Easy way to often do that, look at what you've spent the last few years and kind of figure out, okay, I made X, I saved Y, my actual spending was this. Do you expect that to go up, down in retirement? I know historically a lot of people would think spending would go down in retirement, but oftentimes, especially the first few years of retirement, I find that's not true. People want to get out and they want to travel. They want to visit family. They want to go abroad. They want to join the country club, yada, yada, yada. And personally, the kind of retirement I want to have, I hope that I am spending more my first few years of retirement. So something to take into account. But once you kind of get an idea of what your spending needs are, you're going to want to reduce that number by your other sources of retirement income. Do you have a pension from your job? How much is your Social Security going to be, etc.? So the final number is going to be kind of your plug. So what is your remaining spending needs? And then you just divide that by 0.04, which is that 4% withdrawal rate. And that will give you the number you need in terms of assets to successfully retire. So quick example on that. Let's say you've calculated your spending needs are $80,000. You have Social Security or other funding of $30,000. So now you're left with a $50,000 funding need. If we divide that by the 4%, we come up with a $1.25 million portfolio that a 65-year-old retiree would need to have. Obviously, these are pretty simplistic numbers, but I often find simple wins the day. We want to make conservative assumptions to make sure that you are setting yourself up for success. So, retirement planning is it's not an exact science. There's so many variables. We don't know what future tax rates are going to be. We don't know if you're going to get hit with an unforeseen circumstance. Do you suddenly have to repair a big roof? Do you have a big thing happen? Does this or that? What's inflation going to be? There's always so many variables, but we just want to do our best to kind of come up with a good plan for you and your circumstances. So love putting together these kind of projections and doing that kind of planning. If that's something you're ever interested in, be happy to do a free consultation to kind of discuss your situation. And please share this video and love it when you like and subscribe. Thanks a lot for tuning in today.